Welcome to the UTI Swatantra series powered by ET Now. On this very wonderful evening, we're at the KJ Somaya Institute of Management and we're joined by very young people who are going to be hitting the workforce very soon and who are going to be potential investors. We're going to try and find out what investments they find most interesting, and then we're going to try and help them get started in this wonderful world of financial services. To help me answer their questions this evening at the Institute, I have a wonderful panel of three gentlemen who join me. Gentlemen, thank you so much for joining us. Maybe about 8 or 10 years ago, when we spoke to people who were just joining the workforce, there were very few people who even knew the difference between a mutual fund or an insurance policy. Young people today are far more clued in. They know what they want out of their investments. But it's also become a materialistic world. Today I can buy a cell phone for 60 or 70,000 rupees. And in my personal opinion, when you make your first salary, you should allow yourself a little bit of room to enjoy it, to take your friends out, to buy that one big thing that you wanted to buy. But at what point, after they start working, would you recommend they start saving?
Trust me, guys, schools, colleges, MBA institute, they don't tell you financial education. But I feel the most important piece is you guys are the richest guys. According to me, you guys are the richest guys. Because compounding, the magic of compounding starts with people who start early in life. For us, I'm a 37. For me, let's say if I want to retire at 60, I have 23 years. For you, you have 35 years. So trust me, the compounding magic, that tree for you will be much bigger. So to my mind, I think you should do maximum saving. This is the right time, and I think this time you don't have obligation, you don't have commitment. So I think you should start saving as much as you can, and it should go all in equity. I would say all in equity.
We're just going to do a very, very basic 101 class on how a mutual fund functions, since that's what we're here to talk about. What a mutual fund is and how it functions.
See, when we talk about mutual fund, it is not just predominantly equity. I will bifurcate mutual fund into 3 to 4 asset classes. One is equity, one is fixed instruments, one is commodities like gold. When I'm talking about mutual fund, predominantly why one should go into mutual fund is it brings in a lot of advantage of professional management, diversification of your assets, professional management from fund managers who are experts in managing the money. It brings in a lot of transparency. Let me tell you, our regulator SEBI has done a fantastic job to make the mutual fund market very, very transparent and well regulated.
We noticed that there are a lot of fans of the fixed deposit here. Yeah, fixed deposit is, it's zero cost. It doesn't cost me anything at all.
What kind of returns you generate in fixed deposit? 8-9%, right? What has been the average return? So if I look at last 34 years of Sensex return, if I talk about, the average CAGR return has been 17% CAGR, 17% every year return. So what has been the difference in return? Average 7-8% you generate extra. So do you feel this 7-8% is good, big? Yeah. So I have done one study wherein, let's say, if anybody puts in, let's say, this money, 25,000 every month if anybody puts in for next 20 years. If a 15% CAGR asset class is there, like a mutual fund, the value of that asset after 20 years would be around 3.75 crores. Around 3.7 approximately. With a 8% fixed deposit, it would be roughly around 1.5 crores. The difference is approximately a 2 CR. So this 2 CR difference, this is power of 7. The extra 7% which you can generate. Again, why should you put money in fixed deposit? Fixed deposit, you should put money if you need that in emergency. I would, as a financial advisor, I always look at fixed deposit for my contingency balance. Next 3 months, if I need money for my expenses, I think fixed deposit are best suited for that. For long-term wealth creation, I think only 2 asset classes are there, real estate or equity. For that real estate, I think it requires huge amount of investment. For equity, you can do as small as 500 rupees also. So I feel there is no option other than this for long-term wealth creation. So guys, stop doing fixed deposit. I think if you have money for next 5 years, just put it in these.
Okay. Do we have any questions? Yes? Okay, over here.
So at this age, what plan do you suggest in mutual fund? Like you said, there are large cap funds, mid cap, small cap. So at this age, which fund we should choose?
See, it all depends upon your risk appetite. When I talk about three categories, which is large and multi-cap, they will be investing in top 100 companies of India. Probably I would say Nifty or Sensex. When I talk about mid-cap, it will be the second-run companies. So if you are a high-risk investor, I would prefer you going in for a mid-cap. Because today's mid-cap will be tomorrow's large-cap. So at this age, probably a higher allocation to mid-cap makes a better sense than a large-cap fund.
I have one point to make here. Before asking this question, I want you to understand one very important thing. Before doing any investment, there need to be a goal orientation. Without goal orientation, no investment should be done. So this large cap, mid cap, this small cap, all these conversation will not take us anywhere. The most important thing all of you need to identify, first of all, is for what this money is. Like, you need to have a vision, right? Every company has a vision. So your money also need to have a vision. For what I am saving this? You need to first identify what your goals are. First, if you have identified your goals, I think then we can break it into which funds to look at. A large cap, mid cap, small cap. I think that would be an easier thing to do. So I would recommend to first set your goals and then only start looking at investment. Don't do random investment.
How many of you are considering your retirements at this point? You are? Okay, all right. That's good to know. How many of you are considering perhaps getting a job for the next 2-3 years and then quitting and starting your own business?
Yeah, very nice.
I think, this is the other interesting change. What used to be, I want to buy a house, has now become, I want to be an entrepreneur. And let's just, since there are so many people who feel this way, let's tackle that. If I'm going to start working today to be an entrepreneur, which means that I will quit maybe 3-4 years down the line once my business plan is done, once I know what I'm going to do, there are a couple of things I need to watch out for. A, I'm going to stop making an income. I will need a seed capital to start my business. And I'll need to have my own insurance, my own retirement plan, my own savings plan to compensate for the fact that I no longer have PF, I no longer have my employer's insurance, because once you quit, all of those benefits will also go away. So if I'm looking at doing that, say, 3-4 years down the line, what do I have to do now to be ready then?
See, when we are talking about equities, if you don't have an investment horizon of probably 5 to 10 years, it does not make any sense. When we are talking about starting our own business, probably after 2 or 3 years, this is the money where we have a very limited risk appetite, because this 100 rupees, if it becomes 106 rupees, good, but if it becomes 80 rupees, probably it's not fine with us. So for such kind of time horizon, a debt product will make a much better sense, where 100 is going to become something more than 100, but at least it will not become 80 rupees. So it depends upon horizon. So when we are talking about 2 to 3 years horizon, I believe we should accumulate that money into a debt instrument, which is going to grow at presently about say 8 to 9% per annum, and which is available to us at whenever we want that money for us.
Any more?
Yeah, so one point I want to make is, one very important thing which I learned is you need to have at least 2 years of expenses which you are going to incur should be available with you as a corpus. That will really help you to take any headwind in the business. That is one very important thing. But guys, if you want to do business, you need to be very headstrong. Because I think your opportunity cost today, I assume that 8 to 10 lakh would be your average placement package here. So your opportunity cost is like that. If you want to start a business, you really need to be high in passion. Then only you can do it. Otherwise, you can't do it.
Do we have any more questions? You had a question.
What I was asking was, if I have a goal set, so I'd rather research about 5 stocks and invest into it rather than going for a mutual fund. So, why do I go for a mutual fund?
One very important thing is when you buy a stock, so the most important thing, how committed you are in terms of doing that continuous study on that stock. So just buying a stock will not help. Every quarter. So when I have been in this business for last 15 years, any stock you buy, every quarter there is a quarterly result. Yeah. Every 1 year there is a AGM. So how committed you are in terms of doing all these exercises on a regular basis. There is a global shock. There is a lot of challenges which keep coming. So I'm not sure how you will be able to give that much time towards that point. So a mutual fund manager is doing that job for you. So better you are with that 2.5% cost, you are getting that expertise. That's the whole idea.
You had something to add,
Yeah.
Piyush, go ahead.
Adding to his point, if you buy a stock and whether it is possible to go and see a management and ask them whether what is your expansion plans, how your sales are going to grow, how your bottom line and top line is going to grow, whether it is possible by buying 5 stocks, not possible. So in fund you will get collective effect, and fund manager and his research team can ask these questions to the management if they are going to buy some more quantity of particular share. So where our research lacks, and that's why direct equity is very difficult to trade, or you can invest, but fund it is very easy.
You wanted to add something?
Probably what he's pointing out is meeting the promoters and the management. With this, the kind of money we are talking about, we'll never be able to seek an appointment to the meeting. So it's all information. If you have the bandwidth, if you have the infrastructure, yes.
Okay. I want to invest into a mutual fund. So how do I select which mutual fund house to go with? Number one. And number two, there are a lot of things that are attached to the mutual fund manager itself. So what happens when he switches from one fund house to another? And rather than investing in a mutual fund, why don't I go for something like an inflation-adjusted bond? Because that will be giving me somewhere a higher return, and it will be inflation-adjusted, so it will be better for me anyways. So.
Good question.
I'll take.
Yeah.
So your first question was that which mutual fund to invest, right? Where to invest? I think it all depends on what time frame your investment horizon is. Let's say your time frame of investment is, let's say, 1 to 2 years. You need to look at debt schemes only. If your time frame is more than 3 to 5 years, you can look at balance and debt. Dynamic asset allocation funds could be looked at. Time frame more than 5 years, you should look at equity. And in equity also, if your risk appetite is higher, you can look at mid cap, small cap, large cap, all these things you can look at. Second thing is, you said when the fund managers keep changing. Yes, it is definitely a risk, but I would recommend go with fund houses which are most system oriented rather than people oriented. I think that is the only way to look at it. Yeah.
Fund manager coming out and going, that is the process. But some AMCs are there which are having the fund manager for last 13, 12, 16 years. They are still with the same AMC. So, but that is not at all affecting the performance. So, and again, that his point, it's you should have your goals. Set your goals, then that will be much easier to find a product.
Okay, I'd like to thank all of you for your time. Gentlemen, thank you for spending time with us. It's been a very, very interesting conversation, and I wish you all very, very good luck with your careers ahead.
All the best.
Thank you.